delivering true value, exploring great books from around the world. Hello, this is Sally's Book Talk. Today, I'm going to interpret the book The Memoirs of Benjamin Graham, the Godfather of Wall Street. Benjamin Graham was an outstanding American investor and the teacher of Warren Buffett, known as the Stock God. This book is a memoir personally written by Graham in his later years. In it, he recounts over 60 years of his life story, from birth to retirement, sharing his more than 40 years of tumultuous investment experiences on Wall Street and his insights on securities investment. As an investor, Graham had outstanding performance. From 1936 to 1956, a 21-year period, his annual compound return was 17%, placing him among the top performers in Wall Street history. Graham is also known as the father of securities analysis. It was he who made securities analysis a formal profession in the investment field. At the same time, Graham was the founder of value investing theory. He personally taught securities analysis courses at universities, teaching value investing theory and practice. His investment wisdom nurtured a group of highly accomplished top investors, which is why he is revered as the godfather of Wall Street. Graham's most famous student is Warren Buffett, the stock god. Buffett once said, "Graham's influence on me is second only to that of my father." By understanding Graham's investment philosophy, we can better grasp the origins of Buffett's investment thinking. All right, next, I'll interpret Graham's memoir from three aspects: his life story, career story, and investment wisdom. First, let's talk about Graham's life story. On May 9th, 1894, Benjamin Graham was born in London, England. He was the youngest of three boys in his family. Graham's father was a Jewish businessman who ran a business importing porcelain from China. When Graham was 1 year old, because the family business was expanding to the United States, the whole family moved from London to New York. Graham's father's business was doing well, and the family lived a comfortable life. They lived in a large house in a wealthy neighborhood, with a maid, a cook, and a French butler employed at home. However, as fate would have it, when Graham was 9 years old, his father suddenly died of pancreatic cancer. The pillar of the family was gone, and Graham's mother, Dora, had to raise three children alone. Later, due to business and investment failures, the family lost most of their savings. Even their house and furniture were auctioned off. With no source of income, the Graham family's life fell from affluent middle class into poverty. The children of the poor mature early. At age 12, Graham started doing various odd jobs to earn money, like selling magazines, working on farms and in theaters, assembling telephones. In middle school, he also tutored a general's children in mathematics. Recalling these difficult childhood years, Graham said, "Just after turning 12, I already knew how to strengthen myself against fate's tricks, how to earn money in various ways, how to focus on completing necessary work, how to strive relying solely on myself." Childhood poverty filled Graham with a strong desire to earn money. Graham excelled academically during his student years, thanks to his self-discipline, hard work, and thirst for knowledge. Graham's family practiced Orthodox Judaism, but he decided to abandon religious faith in his teens. He believed religious faith conflicted with his pursuit of rationality. This showed young Graham had begun pursuing rational thinking, the most crucial trait for investment success.
After high school, Graham entered his dream school, Columbia University. He majored in mathematics while extensively studying literary, historical, and philosophical classics, mastering both arts and sciences.
This laid a solid foundation for Graham's future investment analysis and academic research. Graham believed self-education was the best and most enduring form of learning. He persistently read extensively and pursued lifelong learning. Later, outstanding value investing masters like Warren Buffett and Charlie Munger followed this same approach.
In 1914, Graham graduated from Columbia as an honor student, ranking second in his class. The chairs of English, philosophy, and mathematics departments simultaneously invited him to join their faculties.
This was the highest honor any graduate had received in Columbia's history. At just 20, Graham chose not to teach because he yearned to earn money and achieve his wealth dreams. Fate intervened when Wall Street financier Neuberger asked Columbia's president for a tutor for his son. He also requested a recommendation for an outstanding graduate to join his firm. The president immediately recommended Graham. This chance opportunity brought Graham to Wall Street, launching his 50-plus-year investment career in American securities. Like others, life isn't always perfect. Graham's adult family life wasn't smooth sailing. In 1917, at the age of 23, Graham married for the first time. Over his life, he had 4 marriages and raised 6 children. Unfortunately, in 1927, his eldest son died of meningitis at age 9. Another son committed suicide as an adult due to mental illness. The deaths of both sons caused Graham immense mental anguish. In his personal life, besides his investment talents, Graham was passionate about literary writing. He wrote many poems and several plays, one of which was produced as a stage play and performed on Broadway.
This reflects another side of Graham's character, idealistic and romantic.
In his later years, Graham devoted more time to philanthropy. He served consecutively as president of the American Jewish Blind Society. Those around him, family, friends, and colleagues, consistently described Graham as upright, kind to others, and fair-minded. Okay, that concludes Graham's life story. Next, let's talk about Graham's investment career. To summarize, Graham's investment career is divided into 3 main phases. The first phase, from 1914 to 1923, spanned 9 years, during which he worked at a securities firm. The second phase was from 1923 to 1935. During these 12 years, while managing fund accounts, Graham experienced the trials of the Great Depression and the stock market crash in the U.S. The third phase was from 1936 to 1956, when he founded Graham Newman Corporation, which is equivalent to a modern-day fund management company. This period was the most glorious years of Graham's investment performance in his lifetime. Next, I'll first introduce the first phase of Graham's investment career. In 1914, after graduating from university, Graham joined a securities firm founded by Neuberger. And now, 1914 wasn't a good time to enter the securities industry. At that time, World War I had just broken out. Investors were panicked, and the New York Stock Exchange was forced to close temporarily. Initially, Graham worked in the bond department doing sales, but he wasn't very interested, so he switched to bond analysis. Statistical analyst. His bond analysis reports won praise from clients and management. Later, he took charge of the company's newly established investment research department. Actually, it was after joining Neuberger's firm that Graham truly began learning about securities and investment, and he proactively started researching and analyzing the financial statements of listed companies. And the U.S. stock market at that time was in a wild growth era, rampant with speculation. Practices like insider trading, market manipulation, and false reporting were common, with no professional securities analysis being done. Yet Graham's work historically pioneered the profession of securities analyst. In his work, Graham fully demonstrated his mathematical talent. He excelled at dissecting company financial data layer by layer. For example, he used publicly disclosed tax data of listed companies to deduce their goodwill value. Goodwill is an important, intangible asset of a company. Knowing its true value allows for more accurate assessment of a company's overall asset quality. Today, goodwill value is publicly disclosed in listed companies' financial statements. But in that era, goodwill value was considered confidential corporate information, never disclosed publicly. Therefore, Graham's research was undoubtedly advanced for its time. By calculating goodwill value, his company analysis became more thorough and comprehensive than his peers. Graham's work achievements were outstanding. In 1920, at just 26, he became the youngest partner at Neuberger's firm. But Graham was determined to manage investments independently. So in 1923, he resigned from Neuberger's firm and began managing investment accounts on his own. And he, equivalent to today's private equity funds, Graham's investment career entered its second phase. Graham's main investment strategy was discovering and buying stocks priced far below their true value. He would proactively acquire substantial equity in these companies, then persuade management to change capital allocation or operational strategies, allowing the company's true value to be reflected in the market. Oh. This was an active investment strategy. While perhaps common in today's securities market, it was rare at the time. Next, I'll share one of Graham's most representative investment stories. His investment in Northern Pipeline Company. At that time, the stock price was $65 per share, but including bond value, the cash assets per share reached as high as $95. So, Graham immediately realized that if the company distributed this cash as dividends to shareholders, it wouldn't affect its core business operations. But shareholders could make substantial profits. This was a rare investment opportunity. But why hadn't others spotted this great opportunity? Turns out, market investors were generally pessimistic about pipeline companies' prospects, fearing increased industry competition and future performance declines. They also didn't believe management would agree to distribute cash dividends. So Graham began acting alone. He bought 5% of Northern Pipeline's shares in the stock market, becoming the company's second largest shareholder. The largest shareholder at the time was the Rockefeller Foundation with 23% ownership. Graham personally visited Northern Pipeline as a shareholder to meet with management. He strongly urged management to distribute most of the cash to all shareholders. However, the major shareholder Rockefeller family didn't agree with Graham's proposal. Northern Pipeline's management attitude. Therefore, they were very arrogant, using Graham's lack of pipeline business knowledge as justification. They rejected his proposal and rudely told him, "Mr. Graham, if you don't like how we operate, sell your shares." At Northern Pipeline's annual meeting, Graham reappeared and submitted the same proposal, only to be rejected again by management. Graham realized his shareholding wasn't substantial enough to influence management's decisions. After returning, Graham spent an entire year preparing a new plan. He raised as much capital as possible, bought more shares, then personally lobbied every shareholder holding over 100 shares, persuading them to grant him proxy voting rights. The next year, at Northern Pipeline's annual meeting, Graham controlled proxies for over 15,000 shares, representing 37.5% ownership, exceeding the original major shareholder. Facing the Rockefellers, Graham now had the right to elect 2 directors to the company's board. Ultimately, the story had a perfect ending. Northern Pipeline's board approved Graham's dividend proposal, distributing $70 per share. Plus the profit from selling the stocks, Graham earned over $100 per share, with total gains of at least $200,000. This battle with the listed company made Graham widely famous on Wall Street. This story fully showcases Graham's ability in company research and analysis, as well as his skill in turning intrinsic value into actual investment value. Of course, the investment path wasn't smooth. Graham also faced major trials of fate. In 1929, America's 9-year-long bull market came to an end, ushering in a brutal bear market. Graham's investments suffered heavy losses, and his company nearly went bankrupt. That was the darkest moment in his investment career. Recalling this experience, Graham quoted Dante's verse, "At the end of life's journey, I found myself lost in a dark forest." Actually, before the 1929 stock market crash, Graham had already realized the market was overheating, but the young Graham was subconsciously confident and didn't think he'd be toppled by the storm. And so the story of the Graham's confidence came from his early use of arbitrage and hedging strategies, which are common in hedge funds today. Back then, Graham's hedging strategy involved buying preferred stocks while short selling related common stocks at roughly the same price. When the market is down, common stocks fall much more than preferred stocks, so the hedged portfolio could still profit during declines. However, in extremely volatile markets, closing positions becomes harder because stocks are tough to sell during a crash, making hedging impossible. The bear market in the Great Depression era was brutal. The U.S. stock market's Dow Jones Index fell from a high of 386 points in 1929 to a low of 42 points in 1932, over 3 years, with a drop of nearly 90%. Even blue chip companies' stocks couldn't escape misfortune. For example, U.S. Steel's stock price fell from $262 per share to $21. General Motors' stock price dropped from $92 to $7, making it an exceptionally painful experience. Graham lamented, "1930 was the worst year in my 33 years of fund management history." At the time, stock prices fell sharply, but Graham believed the intrinsic value of the stocks he held was far above their market price. So he kept holding on. The main reason he got into trouble was leverage in his investments. That is, he borrowed money to buy stocks. When stocks fell, collateral shrank, forcing constant margin calls. Meanwhile, the illiquid market made selling stocks to repay debts extremely difficult, worsening the situation.
During the 3 years after the Great Depression, Graham's investment losses reached 70%. Combined with investor redemptions, by 1933, assets under his management had shrunk by 80%, from an initial $2.05 down to just $375,000.
Since most of Graham's personal assets were also invested in his fund, he suffered equally heavy losses. Before the crash, with high income and comfortable living, Graham gradually developed tendencies to show off and compare himself to others. He hired several servants and a full-time butler, spending lavishly to renovate the luxury mansion he rented. The mansion's rent cost as much as $11,000. During the crash, he could no longer afford the mansion, servants, or butler. Forced to move to cheaper housing, he returned to living a frugal life. In painful reflection, he gained clearer understanding of life, feeling ashamed of his past flaunting and extravagant lifestyle. With no fixed salary or investment income, Graham earned money by teaching at universities, writing for financial magazines, and providing asset valuation services to sustain his livelihood. Ultimately, Graham survived the bear market. In 1933, his investment return exceeded 50%. By the end of 1935, he had recouped all previous investment losses. The 1929 to 1933 investment experience became the turning point in Graham's entire investment philosophy and practice. Reflecting in his memoir, Graham said, "Had I followed others' advice and luckily escaped the crash, I wouldn't have experienced that pain and regret." But another question, without those painful experiences, could I have developed my current character? Could I have achieved today's success? Indeed, it was the setbacks during the crash that exposed deficiencies in Graham's investing, accelerating his refinement of investment philosophy toward maturity. It was also during those difficult years that Graham began writing amid painful reflection the book Security Analysis. Later, this book became a groundbreaking masterpiece in the history of securities investment. After the storm cleared, Graham entered the third phase of his investment career. In 1936, he founded Graham Newman Investment Company, equivalent to today's private equity management firms, embarking on a new investment journey. In 1954, Warren Buffett also worked at Graham Newman Company for 2 years. From 1936 to 1956, over the 21 years until Graham's retirement, Graham Newman Company achieved an annual investment return of 17%. Surpassing the 14% average annual return of the S&P 500 index during the same period. Graham's investment returns firmly placed him among the top ranks of Wall Street's best investors. Next, I'll discuss Graham's most successful investment, the story of his investment in Geico. The full name of GEICO is Government Employees Insurance Company, primarily operating in auto insurance, founded in 1936 by the Goodwin couple. In 1948, Geico's major shareholder wanted to liquidate their stock, and after some twists and turns, they approached Graham Newman Company. At that time, Wall Street wasn't optimistic about the insurance industry, but after investigation, Graham believed this insurance company was worth investing in. First, Geico primarily served clients like government employees and military personnel, who have stable incomes and lower accident rates for driving. Thus, Geico held a portfolio of high-quality auto insurance customers. Second, the company used a direct mail approach for policies, with no middlemen taking commissions, resulting in sales costs 30% lower than insurers with agents. Therefore, Geico's profit margins were about 15 to 20 percentage points higher than the industry average. The low costs and high-quality customer base gave Geico a significant competitive advantage. So, Graham used a quarter of his company's assets to buy nearly half of Geico's shares, making this the largest proportional investment in Graham's career. Later, Graham gained controlling interest in Geico, became its chairman, and pushed Geico
To list on the New York Stock Exchange in 1948. By 1970, Geico's stock price had surged over 200 times, and Graham turned his initial $720,000 investment into hundreds of millions in profits, marking his most successful and profitable investment.
He earned more money from Geico than the total investment returns of the previous 20 years. Graham later recalled that the investment in Geico was incredibly fortunate. However, this wasn't a typical Graham-style investment. Typical Graham investments usually bought at bargain prices and were highly diversified, rarely held beyond 3 years. But Geico was purchased at just a 10% discount, not particularly cheap. Moreover, Graham invested a quarter of his firm's total assets, concentrated heavily in one stock, and held it for 17 years. This resembled Buffett's later style. In 1956, while the U.S. stock market was still in a bull run, Graham decided to retire after 42 years on Wall Street. After retiring, he chose to teach at the University of California. His greatest interest shifted from stock investing to academic research and sharing his ideas with broader audiences. Okay, that concludes our interpretation of Graham's investment career. Next, let's discuss Graham's investment wisdom and historical contributions. Graham's two most influential works are Security Analysis and The Intelligent Investor. These books impacted Wall Street's investment history and fully present Graham's investment philosophy and wisdom. Security Analysis took 7 years from preparation to publication. As early as 1927, Graham personally taught a securities investment course at Columbia Business School called Security Analysis. No other universities had similar courses then, and with the stock market booming, Graham's course became immediately popular.
In class, Graham analyzed real stocks. So many students directly mimicked his picks after lectures.
The stocks discussed in class consistently made money, greatly boosting Graham's reputation. Classrooms overflowed with attendees, even attracting Wall Street professionals. David Dodd, Graham's teaching assistant, later co-authored Security Analysis. Security Analysis is considered the Bible of value investing, a highly professional work. It systematically discusses value investing concepts, methods, standards, and principles. Like a biological dissection, Graham meticulously analyzed investments in common stocks, preferred stocks, corporate bonds, convertibles, and demonstrated financial analysis of public companies with real cases. The book Security Analysis conveys the core philosophy of value investing. Stocks represent ownership in a company, not gambling chips. Therefore, invest, don't speculate. Buy when stock prices are well below the company's intrinsic value. In simple terms, it means buying a dollar's worth of stock for 50 cents. Graham reminds investors not to obsess over market ups and downs, but to focus on uncovering a business's intrinsic value. When Graham's security analysis was published, the U.S. stock market was severely depressed. One-third of American company stocks sold at low liquidation prices, yet investors were pessimistic and scared to buy. Ugh. Thus, security analysis arrived at the perfect time, offering highly practical guidance. Graham's other book, The Intelligent Investor, was first published in 1949. In this book, Graham explains the most crucial investment issues in simpler, more accessible language. Warren Buffett read this book at age 19. Buffett later recalled, "Back then, I thought it was the best book ever on investing. I still think that now. This book not only changed my investment approach, but also my life." The Intelligent Investor features two famous concepts. One is Mr. Market, and the other is the margin of safety in investing. Mr. Market is a metaphor. You can picture the stock market as being orchestrated by Mr. Market. When you trade stocks, you're dealing with him. Mr. Market quotes you a price daily. But Mr. Market is moody. He quotes high prices when optimistic and low prices when pessimistic. Regardless, he offers a new price every day. So the wilder Mr. Market's mood swings, the better for you. You can buy stocks cheaply from him when he's down, or sell high when he's up. This captures the essence of Graham's Mr. Market. Graham advises investors to remember that Mr. Market serves you, not guides your investments. For individual investors, maintaining a sound mental state unaffected by the market is vital. Individual investors must rationally avoid the herd effect, meaning don't chase market emotions. In The Intelligent Investor, Graham also poses a question. What if I had to condense all my investment wisdom into one sentence? To this, his answer is the margin of safety, another crucial concept in value investing. He meant that when buying stocks, the price must be significantly below the estimated intrinsic value. Simply put, buying a dollar's worth of stock for 90 cents isn't safe. Buying for 50 cents provides true safety. To avoid risks from excessive optimism or misjudgment, sufficient margin of safety is essential. We at Sally's Book Talk have previously interpreted The Intelligent Investor. For deeper understanding of Graham's philosophy, listen to our episode, Revered as the Godfather of Value Investing on Wall Street. He mentored accomplished disciples including Warren Buffett, Bill Ruane of Sequoia Fund, and the Schloss father-son duo. In 1984, Buffett delivered a famous speech at Columbia titled The Super Investors of Graham and Doddsville. In it, he listed 9 super investors who successfully practiced Graham's philosophy. Despite constant market changes, Graham's value investing remains an eternal guiding light. That concludes the essence of this book. On September 21st, 1976, investment master Benjamin Graham passed away. He chose Ulysses' final line as his epitaph: to strive, to seek, to find, and not to yield. Perfectly capturing his life. All right, that wraps up our interpretation of the Memoirs of Benjamin Graham, the Godfather of Wall Street. Reading notes below. See you next time.